Welcome everybody to this video. This is Urban Catalyst's top opportunity zone tax questions. I am Morgan Mackles, head of investor relations at Urban Catalyst Fund. So to help us answer these questions, we thought who better than an actual CPA. So our special guest today is Nick Gibbons, CPA. He is a director of tax with Armanino. Over 17 years of experience and expertise. Nick is actually an expert in corporate taxation, as well as opportunity zones and cryptocurrency. So with that, we're going to welcome Nick and get started with the questions. So Nick, for our first question, let's start at the very beginning, at the origin of the opportunity zone tax program. Where did this come from, and where is it within the IRS code?
Yeah, great question. And it has an interesting history. It really was conceived by Sean Parker and his economic innovation group, which was tasked really to figure out a way how to bring all of this wealth that has accumulated over time and be deployed into census tracts, areas of land that could really benefit. So really share the wealth, but also be a good deal for those, individuals or entities that have that wealth. So it was designed to be a win-win and be an efficient way to just make other areas of the country improve. So that was the genesis of it, but it didn't become law until 2017 under the Trump administration. And it was brought to law by, it was a bipartisan. So you had Senators Tim Scott and Cory Booker, as well as U.S. Representative Ron Kind. And it was signed into law within the Tax Cuts Jobs Act of 17. So it's a code section, it's a brand new code section within the within the Internal Revenue Code. And those code sections are 1400Z-1 and 1400Z-2. 1400Z-1, it just has to do with the zone's nomination process and designation. So all the rules fall under 1400Z-2. So that's how it came into the law. It's been codified. It's an Internal Revenue Code. The final regs came out last December. They were technically published in the Federal Register in early January. I think it was January 13th this year, 2020. But so we're done here. So we have like all the rules explained, and it's part of the code now. And also just a side note, I know we're in the there's about 5 days, or we're close to the election, and it doesn't, from what I've read, it doesn't really matter who wins, because this is a bipartisan program. If Trump wins, this program will most likely strengthen, and if Biden wins, it's going to remain. There may be some more reporting requirements, but that may not be, that might not necessarily be a bad thing. But I guess my point is that this is not going away anytime soon.
One of the questions we get a lot at the very beginning, Nick, from our investors is, hey, we've heard about the tax benefits inherent in this new IRS tax code. What are those main tax benefits?
So I think the best way to explain this is just coming up, just to walk you through a simple example. So the first one, the defer. Let's say you have $1 million of stock appreciation. So you're sitting on an unrealized, what's called an unrealized capital gain. Say you want to take take advantage of 1400Z-2, the Opportunity Zone program. You find a great fund, and there's some rules that we can discuss later. But say you find one, you identify a fund like Urban Catalyst, say for example, and you invest that $1 million of stock, that gain, into Urban Catalyst. So normally that would be obviously a taxable event. You would have to pay capital gains tax, and it would be as high for federal purposes, 23.8%. So, but the deferral is you do not have to pay that tax during the year that you're investing. So say it's this year, 2020, instead of on your 2020 tax return, you're paying that tax. You don't have to pay the tax on that gain until 2026. It's important to distinguish, though, and to remember that you do pay tax on the investment, on your investment or on your initial investment, on that initial capital gain that you're investing into a qualified opportunity fund. So the second is a reduction of that tax. So instead of paying, in our example, instead of paying 23.8% on $1 million, you would pay 23.8%, or whatever the rate is at the time of 2026, times 900,000. You would get 10% off of that taxable gain. And then the third, the best, is if that investment appreciates over time, over 10 years, and then it's sold, you cash out of your appreciation, all of that, 100% of that is tax-free, federally tax-free. And that's really the primary benefit of this whole program.
Hey, Nick, so you mentioned that these gains that are part of the Opportunity Zone program have to be capital gains. So
right.
What about ordinary income, and why did the government choose capital gains for this program?
So why did they do that? Why did they say only capital gains could be invested in these vehicles? Well, I think it goes back to Sean Parker's original thinking, and that there's all of this unrealized, there's this wealth that's just sitting there, How do we get some of that into areas that could really benefit from that wealth? And it's not via ordinary income. Think of it as you're moving some of that wealth into an area so that you can help people raise their ordinary income. But the initial investment only applies to a capital gain. And so that's a sale of property, like stock, cryptocurrency, a business, anything that's characterized as a capital gain. So that's basically why it's capital gains and not ordinary income.
The next common question that we get is about the 180-day deadline. So why does the IRS have a 180-day deadline to make an Opportunity Zone investment? And let's start off there with maybe a little explanation of the 180-day window, as the IRS calls it.
Okay. So continuing our example, the $1 million stock appreciation. Once you realize that gain, so go into E-Trade or whatever, and you cash out your gain. So now you're sitting on $1 million you have access to. The IRS gives you 180 days to identify or create an Opportunity Zone fund, which is called a QOF, or Qualified Opportunity Fund. And why 180 days? Because it's a meaningful period of time. It's probably it's the same amount of time with Section 1031 gains, which is probably why they used 180 day, specifically 180 day, but it has to be less than a year, because if it was more than a year, then that's just a whole nother year of deferral, and that's not part of this program. So they want that wealth to actually be deployed relatively soon into these census tracts.
So Nick, an investor in 2020 actually may not be subject to the 180-day deadline, correct?
That's correct. Yeah, because of the COVID crisis, there was a notice that came out that it essentially extended this period till the end of this year. Technically, I think it covers from October 4th, 2019. If you had a gain then, you have technically till 12/31/20 to identify or create your own opportunity fund.
So if I was an investor who recognized a gain anytime from October the 4th of 2019 all the way through to the end of 2020, I would have my 180-day deadline extended until at least December 31st of 2020, correct?
Correct. That's correct.
So what happens for individuals who might sell stock, now in the winter, in October, November, December of 2020?
Right, great question.
Their deadline?
Well, it would be 180 days from the day. So if it's today, you would count literally 180 days. And by that day, you would have to invest that money into a fund.
And how does the government going to know? How is the IRS going to know if you made an investment in time within that 180 days?
That's a good question. So how would the IRS know? Well, when you cash out, right? Let's say you're just hitting sell on whatever tax or whatever
Robinhood or whatever. Trade Robinhood.
On Robinhood, let's say, Robinhood's going to tell the IRS via a 1099. So this form goes to the IRS, and under your social security number, the IRS is expecting you to have that $1 million on that return. So that's how they're going to catch you. If you wait longer. For as far as like say it's over 100 days and then fewer than the 365, I would just guess that that would be bad. I mean, you wouldn't want to break the rules on that, because they could audit, especially if you're successful down the line. There's a good chance that the IRS will audit you, and they would nullify the entire program for you because you didn't follow that rule, the 180 days. But to answer your question, it's via Form 1099 of Robinhood. Robinhood's letting the IRS know.
So it sounds like you need to make sure that you're making a qualified opportunity fund investment within 180 days, and you need to do it with a firm or the fund that is going to provide the proper paperwork to you to prove that to the IRS.
Absolutely. Yes. So yeah, that's a great point. See, a lot of my more than several of my clients wanted to start their own qualified opportunity fund until they realized what a burden really tracking or not burden, but just how much is involved in making sure that the Opportunity Zone program is being followed. Because if it doesn't follow the rules, you have real risk of this not working out. So therefore, I've advised them to find quality opportunity funds, and several of them followed that advice, and I think another just decided not to do anything in the Opportunity Zone. But yeah, so that's right, Morgan. I mean, you want to find, either you need to know what you're doing and hire the proper help, or find a fund that has that taken care of.
Great. Let's move on to the next question. Very common question. You've alluded to it a little bit already in this conversation, but that initial capital gain, when, as you said, when I press sell on Robinhood, what happens with the taxes for that original capital gain?
Yep. Good question. So what happens to that $1 million sale? Well, it gets deferred. So on your 2020 tax return, you would tell the IRS essentially that you have $1 million of taxable gain, but then also report that you're investing in opportunity zone program so that it's just a negative. So you pay zero on for capital gains tax on your 2020 form, but the tax becomes due on the individual's 2026 tax return. So when the 2026 tax return is filed, that's when the tax is owed to the IRS. And then if held for if that was held for 5 years, so you invested by the end of next year, end of 2021, then you would pay tax on 90% of that gain. And it's also important to note that it's going to be the capital gains tax rate in 2026. So that's a nuance that should not be unknown, because it's, I mean, if Biden wins and if the Democrats sweep and they do eliminate the capital gains tax, that rate could be as high as 39.6%. So you have to, you have to consider that, I think.
So it sounds like what you're saying is very important for investors to understand, is that the original capital gains tax doesn't go away. Rather, it's deferred to the tax year 2026. And then when you pay those taxes, the taxes owed have been reduced by 10%.
Yeah,
correct?
That top is reduced. So that million becomes 900,000, but the tax rate is the 2026 tax rate. And that may or may not be what the tax rate is in 2020. But we'll get into how that could be, how that $900,000 and ultimately your tax, how that could be reduced as well.
So Nick, one of the common questions that we get is, we do get investors who are very successful with short-term gains. Maybe they have taken advantage of the tumultuous market here in 2020, and they want to get out. They want to get off the roller coaster, as we say. So what happens if that gain is categorized as a short-term capital gain and not a long-term capital gain?
Yep, good question. First of all, it does qualify. It's a capital gain. So you can take that short-term capital gain and find a qualified opportunity fund in which to invest. The difference really only being the tax rate. So when that tax becomes due in 2026, the tax rate will be the short-term gains tax rate in 2026. So if it were today, say nothing changed in the tax code, you would pay your ordinary tax rate on that short-term capital gain.
So in other words, it sounds like short-term capital gains also qualify.
Absolutely.
And in fact, short-term capital gains have a higher tax rate, so it might be even advantageous to defer and reduce those taxes.
Absolutely. Correct? That's a very good point, Morgan.
Okay, so Nick, one of the things that happens in a partnership fund, such as Urban Catalyst, is that in the initial years of the fund life cycle, we might have losses. Do you want to explain to potential investors a little bit about how those losses could potentially work?
Yeah, of course. So in a partnership, the partners will receive their allocable share of the business activity. So if the fund's generating losses, which most will at the beginning of the period, those will get passed on to the tax partners, or not tax partners, but to the partners of the partnership, and those are considered passive losses. So let's say I'm the guy that had the $1 million and I invested into you guys, and then year 2 or 3 on my what's called a Form K-1, I see that there's a passive loss that's allocable to me of $25,000. So there's a $25,000 loss that I'm able to take benefit of, but it's a passive loss, which can offset passive gains. So that's one of those additional tax benefits. Going back to that question of what are the main tax benefits. It's not a main tax benefit, but it would be a benefit.
So it sounds like in the early years of an opportunity zone fund, you may actually be getting tax paper losses that can help decrease the amount of tax that you might owe,
Yep.
even if they're from other investments.
Yeah, exactly. And those passive losses are carried forward. So you can carry forward those losses.
Nick, tell us what you mean when you say carry forward losses.
Well, in other words, that $25,000 loss, I wouldn't. So if I wasn't able to use that loss in the year in which I got that loss, right, in the year in which I get the K1, it doesn't just go away. It stays there. It's what's called a deferred tax asset. We don't need to get into tax accounting. It's an asset to you. That loss gets carried forward indefinitely with the current laws as written.
Another really common question that we get, Nick, has to do with depreciation. And for our fund in particular, the depreciation will start for the investors towards the middle and the end of the fund life cycle. But depreciation is obviously extremely common in all types of real estate investments. So can you talk a little bit about depreciation in the context of an opportunity zone fund?
Okay, so one of the other benefits, aside from the main three and the one we just discussed, is depreciation. And why is that I mean, it's just the same thing as the last question, right? Is it just increase your losses and you get a passive loss? No, the final regs establish that once you sell your investment, you do not have to pay tax on that depreciation, which you normally would under what's called depreciation recapture rules. So normally you would actually have to pay back tax on that depreciation.
So Nick, you just told us about depreciation. And I know a standard part of selling real estate is that when you sell your property, the government wants those dollars back.
Right.
My understanding is that term is called depreciation recapture. So what is it unique about depreciation recapture in an opportunity zone investment?
Well, what's unique about it is you don't have to pay. You don't have to recapture that depreciation. That's this free depreciation. That's an added benefit thanks to this program. And it was written in the final regulations. That was a real gift the IRS gave us.
So a very important part of the opportunity zone strategy has to do with refinance distributions. And in particular, at Urban Catalyst, we are expecting to give refinance distributions to our investors. So a question we get a lot is, hey, are those refinance distributions taxable? If not, why not? And how does this work?
Yes, it's tax-free because of basis. Distributions of debt financing generates basis and therefore is tax-free. It's easiest to understand this if you just think about a house in a typical 30-year mortgage. As you build equity, if you refinanced, right, that refinancing cash that's going to you is tax-free. So there's really no difference.
Nick, here's a question we get a lot. A lot of our investors have other investments, of course, and they're getting multiple K1s per year. So when that tax comes due for their original opportunity zone investment, what happens if they have other capital losses that they've incurred?
Yeah, that's a great question. And the answer is you can offset that capital gain, that deferred capital gain that's being recognized on your 2026 return. You can take those losses, you can harvest those losses in between the time you invested your gain and 2026 and offset the 2026 gain, which is the 2020 gain that you invested. So it's a huge, it's not huge, but it's another incremental benefit of this overall program. And so with smart tax planning, you could reduce that tax bill even further.
So in other words, you'll be able to potentially chip away at that original tax due if you have other investments that may have incurred losses between the time of your investment and when those taxes are due. Is that correct?
Correct. Yeah. And if, let's say, for example, that Biden wins and, the Democrats sweep everything, right? And the capital gains tax is eliminated, which means, and then the ordinary tax rate goes up to 40%. And you're sitting on some other assets, other investments that are underwater, then it might make complete sense to cash out those losses and offset the gain, because the gain now is being taxed at 40%. So there's all these rate arbitrage planning that you could do and just run scenarios. So, but it's great that you have that flexibility. At first I thought, well, maybe in the regs there's something about that where it freezes that gain in the year that you invest. But it's just like any other capital gain and loss situation.
So it sounds like if you're a prolific investor, there's really some opportunity to do some fancy tax work in between the time that you make an OZ investment and when you owe the taxes on it.
Yes, absolutely.
That must be exciting for CPAs like yourself that work with high net individuals.
Very much so.
So Nick, as we know and you've mentioned, the IRS set the program up so that you only get the third key benefit after you've held your investment for 10 full years. 10 full years seems like a long time. So do we know exactly what the IRS's reasoning was on having that specific 10-year date?
Yeah, well, I mean, it goes to the spirit of the program. I mean, if you look at the preamble, the final regs, or just the initial genesis of the program, it was to provide long-term benefit to these census tracts. So 10 years is a good period of time. It's a good period of time that you can measure the benefits, the economic benefits. And it really wants that commitment.
So Nick, one of the most important aspects of the Opportunity Zone program and of opportunity funds is how does the tax work after the 10 years of seasoning is done? In an Urban Catalyst case, after we sell the assets, the different properties in the fund.
Yep. So how that would work is, let's say that $1 million example, it appreciates to 3 million after 10 years. I would be paid out $3 million. I would report that $3 million to the IRS, and because I've been telling them every year, we can talk about one of these other forms, I would offset it by a negative 3 million, and I would not pay any federal capital gains tax on that entire amount.
So as long as your money has been seasoned for 10 years, then there's no federal taxes on the profit?
Yep.
That's a real thing. That's actually going to happen. That's in the code.
That's the biggest benefit of this whole program.
That's a home run right there.
That's the home run.
Next question. So a lot of Opportunity Zone funds out there are organized as REITs, real estate investment trust vehicles, rather than as opportunity zone partnerships. Urban Catalyst is a partnership. What, Nick, as a tax expert, would you say is the difference for the investor in a partnership versus a REIT?
Well, for one, you wouldn't want to go into a REIT because it's the tax rates. If you're investing in a REIT in an opportunity zone, an opportunity zone REIT, then you're not going to benefit from some of these partnership benefits that we've been talking about, because distributions will be taxable versus distributions in the partnership, as we discussed earlier, are tax-free. So this is the most tax efficient structure. It's the optimum tax structure for opportunity zones to achieve all these benefits. Yeah, so the biggest difference, or the reason why you do not want to invest in an opportunity zone REIT is because distributions from a REIT is ordinary income. It's taxed at ordinary income tax rate, so at a higher tax rate. Whereas in a partnership, the distributions, as we discussed, those pass-through distributions can be tax-free, and so you really don't want to set this up via a REIT, in my opinion. You want to take advantage of the partnership structure.
So, Nick, all 7 of the Urban Catalyst properties are based here in California. Our fund is based right in the downtown San Jose opportunity zone itself, and the majority of our investors are Californians. The bad news is California is a non-conforming state to the OZ legislation. So how does that work for our investors?
Well, how it would specifically work is on your federal 1040, if you're an individual investor, you get to show the IRS that you're taking advantage of the Opportunity Zone program and not have to pay capital gains tax, federally capital gains tax. But on your California form, you would have to pay the California capital gains tax on that, because California is one of like the 3 states that don't, and unfortunately do not conform.
Based upon what you just said, my understanding is Californians are kind of stuck anyway, right?
Yeah.
Because we're a non-conforming state. But we do have investors from other states, and there is a tax implication for them. Which part of their gain is potentially going to qualify for California taxes?
Yeah, okay, great question. So the difference is, if you're an out-of-state investor investing in Urban Catalyst or a California-based qualified opportunity fund, and if you're not in, again, you're not in California or one of those other 3 or 4 non-conforming states, you will also not have to pay your state capital gains tax on that investment. Keep in mind, because the property that you're investing via Urban Catalyst is in California, and then after that 10-year period, when it's sold, you will, unless California changes the rule, who knows in 10 years, but as it's written now today, you would still have to pay capital gains tax on that event.
So the bad news for out-of-state investors from a conforming state is that they will have to pay California taxes at the end of the entire fund cycle. But a conforming state, they will still not owe the state taxes on their initial gain. Is that correct?
Correct.
So, Nick, another really important part of understanding the taxes for the program is making sure that the IRS knows that you're a part of the program. So what tax forms do investors need to submit to let the federal government, the state government know that they've invested in a qualified opportunity fund?
Good question. So let's talk about the individual investor. So using my $1 million example, I'm an investor in Urban Catalyst. I invest that $1 million gain in 2020. So on my 2020 tax return, you would also attach a Form 8997, which basically tells the IRS, hey, I'm taking advantage of the Opportunity Zone program. And this form 8997 would be filed every year that your investment stays in an opportunity fund. So you're like the 1099 telling the IRS that, hey, Urban Catalyst has my game. So there's like a triangulation, right? So we were talking about Robinhood. How does the IRS know if you're paying tax or not? Well, it's because Robinhood's 1099. So how does the IRS know that Urban Catalyst has my money? Well, it's through this form 8997, which is filed again every single year for the years in which you invest. It's not a new form, but on form 8949, you would, on the first year of investment, so in my example, my 2020 tax return, in my form 8949, I would show right there my $1 million capital gain, but then offset by the Opportunity Zone investment, which is then just, takes dollar for dollar of that gain. That's on the individual side. And so then another form, and we've talked about this earlier, but is the form K1, and that's where the distributions are reported, and you would give that to your CPA, of course, and they would run it through the software, and it goes in your return, and you either get to achieve some of the benefits or the tax.
Hey everybody, so thanks for watching this video, the Urban Catalyst Top 15 OZ Tax Questions. We hope that you enjoyed the presentation. If you have any additional questions, please reach out to us at urbancatalyst.com. Thanks.